Hi, my name is John Dowdy, and I'd like to give you a quick review of the stock market for the week ending 23rd August 2013. This is entitled Market Still in Transition with a question mark because we don't know if the market's moving higher or lower. It spent last week bumping up against the bottom of the 50-day moving average. Then on Friday it moved a little bit above it, but it has not been a definitive move. So we're not sure which way the market is trending. Before we start, though, I'd like to say that this analysis is based on what we call technical analysis, which is a review of charts. Some people believe technical analysis works, some people don't. So if you'd like to know why I think it works, at least in some cases, you can come to my website. It's free, and look at the post on why I believe technical analysis works. So the discussion today is going to be, are we making a double top, or is this the pause that refreshes? So let's take a look at the market. As we can see here, this is the S&P 500. This is the SPY, charted SPY, which is the ETF that tracks the S&P 500. And as you can see, we've been in a trend channel, the green line, since November of last year. And this trend channel has pretty well contained the market. We went above it a little bit in May, then dropped below it in June. And now in August, we have dropped below it again. But now we're bouncing back towards it. We didn't quite make it back to the trend channel on Friday. So an important indication of where the market's going is if we can retake this trend channel. You also see that we have a gap here from a 167 to 168. Market's going, that's usually resistance when you have a gap. So the market will have to come back, take out that gap, and move above the 20-day moving average. And all the way up, and for the market to become healthy, we'll have to take out 169, which was the previous high, and then move to an all-time high. If the market moves to an all-time high, then you can relax and feel that the bull is healthy and that the market could be going higher for a significant period of time. However, if it doesn't take out this new high, but instead moves below the 50-day again, and then there could be some problems in the near term. If it moves below the 50-day, the next support is 164.19. That's the low we had in August. If it drops below that, that's a very, very strong support down at the 155 to 156 level. The 155 to 156 is the June low and is also where the 200-day moving average is. So if we fall all the way to 155, this level should provide very strong support, and we should bounce from that. If we move below the 200-day moving average, then we'll have to reassess because the bull market is then in serious jeopardy. But until that happens, we have to give the benefit to the bull. Let's step back and just see where this market falls within the history of bull markets. What are some of the warning signs? Well, the market's 4.5 years old. And according to Investec, which is a good subscription website, there have been 16 bull markets since the 1929 crash, and the average length is 3.8 years. So this market is already above average in length. And it's fast moving to 5 years, and there were only 3 of the 16 bull markets that lasted over 5 years. The longest one was 1990, which was the mother of all bull markets, and that lasted almost 10 years. Then in 74, we had a market that was a little over 6 years in length, and then in 49, a market that was over 7 years. Other than that, we have not had any markets that were over 5 years in length. So sometime the beginning of next year in 2014, this market will definitely become long in the tooth, and we'll have to take a hard look. It doesn't mean that it's going to go down, but the odds are getting higher that the bull market will be coming to an end, potentially within the next few months. Another warning sign is interest rates. The 10-year rate is near 3%. The 30-year rate is near 4%. As interest rates move up, then that's usually a damper on the market. So we need to keep a close eye there. Another troubling sign is margin debt. Margin is people borrowing money to buy stocks from their broker. The margin debt indicates that people are speculating, and the margin debt is the third highest. The only higher margin debt years have been 2000 and 2007, and we all know what happened in 2000 and 2007. That's we had a tremendous bear markets after those years. So keep a close eye too on margin debt. All this doesn't mean that the market's going to go down. It just means we need to be a little cautious. Look at the price action. The price action will tell you more than any of the warning signs. But it just, I would not be aggressively putting money to work in this market at the current time. So in summary, the bull is at a critical junction. It's right above the 50-day moving average, and it's going to have to hold that average in order for the bull to gain strength. If we move up to above 171, then as I said, you can relax. That's an all-time new high, and the bull will be very healthy, and we could look forward to many months of more bull market action potentially. But if we break down below the 200-day moving average, then we have a serious problem. That's around 155. As we're moving down, support is at first at 166. That's the 50-day. Previous lows 164, and as I said, strong support between 155 and 156. If we are going to bounce and move higher, then we're going to run into resistance at 169, and the very strong resistance at 171, the all-time new high. So until we find out if the bull is moving higher or lower, then defensive posturing is what I would recommend. Okay, quick legal disclaimer. The views that I've been discussing are my views only, and they should not be construed as any investment advice. And definitely I'm not making any offer to buy or sell securities. Of course, you are the only one that's responsible for your investment decisions, and you should do your own due diligence before making those decisions. Investing always involves a risk of loss, and you should not use past performance as an indicator of future profits. So next week, let's take a look at the market and let's see if it can give us some more definition of where it's going to go, either bullish or bearish. Good luck in your trading, and thanks for viewing. And if you would like more data, please come to my website, www.superchargedretirementincome.com. Thanks.